Subscriptions. A brief look at some areas in finance theory and practice where integrity is lacking. We turn now to a discussion of the application of this purely positive theory of integrity to finance. We start with some common beliefs, recommended practices, and theory in finance that are inconsistent with being a person or a firm or a system of integrity. We list here some of these propositions and provide a detailed analysis below. Consider the following. The long history in finance, not the law of implicitly defining the fiduciary duty of managers to be to current shareholders only, and therefore ignoring future shareholders and current and future bondholders and other claimants on the firm. As an example of this, we point to the common recommendation for managers with an overvalued stock to issue new stock at the current high price, or make acquisitions using overvalued shares as payment to benefit current shareholders at the expense of future shareholders, and implicitly to hide what they are doing. Common budgeting practices and target-based compensation plans that pay people according to how close they meet their targets. Managing relations with capital markets in a way that views financial reporting choices as strategic and must be made to both manage what the street expects and to give the street what it expects, basically manipulation of the street. Each of these recommended practices is out of integrity and leaves the entity being out of integrity, that is, not whole and complete as to its word. These practices thus create unworkability and destroy value. Consider, for example, the common recommendation for firms whose equity or debt is overvalued to sell stock or bonds at those overvalued prices. That out-of-integrity recommendation, not whole and complete as to its word, is bound to lead to value destruction. The same is true of advice to use that overvalued equity to acquire a less overvalued firm for stock, implicitly hiding what is being done. In both of these cases, the management of the overvalued firm is violating the firm's implicit word to its financial claimants that it will not intentionally take actions that harm them. This is an example of the situation where an individual or an organization is out of integrity if that individual or organization does not either 1. Comply with the expectations of their financial claimants that are unexpressed requests, expectations based on the firm's implicit word to its financial claimants, and even what it simply allows those claimants to expect, or 2. Explicitly and clearly decline those expectations. When new shareholders discover that they were duped, workability will decrease and value will be destroyed. Even if the lack of integrity is never recognized, the executives involved in the unacknowledged manipulation will have diminished themselves as persons, and the firm will have diminished itself as a human entity. Note, however, that the law does provide some obligation of the firm to future bondholders and shareholders through disclosure rules and regulations. But consider the attitudes of sellers of new issues and the investment bankers who counsel them. Few CEOs and few investment bankers who advise them seem to take seriously any obligation of the firm to future bondholders and shareholders when pricing a new issue. When a CEO takes a firm public by selling shares or bonds to the public, he or she is creating a fiduciary relationship between himself and his or her company and the holders of those securities. The word he or she gives implicitly and explicitly to those purchasers regarding the value of those securities is an important part of that relationship. That word must be given with the same standards as that of the fiduciary relationship the sale creates. If the CEO or investment banker speaking for the firm misrepresent, withhold information, or otherwise mislead those purchasing the securities, the firm is out of integrity, and the fiduciary relationship the transaction creates is sullied. Therefore, the ongoing workability of that relationship is damaged. The puzzling state of low-integrity behavioral standards in corporations and capital markets. Here is a list, albeit incomplete, of common actions and activities that result in the word of executives and firms being less than whole, complete, unbroken, unimpaired, sound, in perfect condition. In short, these common actions and activities leave those executives and those firms out of integrity. Out of integrity behavior results in reduced workability and a reduced opportunity for performance, and therefore destroys value. The remainder of this paper is focused on surveying from the integrity perspective examples of these practices, so that we begin to focus on the value that can be created by putting the system back in integrity and correcting the apparent non-value maximizing equilibrium that exists in financial markets. Financial reporting. Managers regularly choose to treat the firm's relations with the capital markets as a game where financial reporting is not driven by creating long-term value, but is little more than a strategy for managing and meeting analyst expectations, often referred to as guidance. Managing earnings, income smoothing, and manipulating financial analysts does not leave the word of executives or the word of the firm whole and complete. These practices invariably leave executives and firms out of integrity with respect to word-4. One's word as to the existence of something or some state of the world includes being accountable that the other would find valid for themselves the evidence that one has for asserting something to be the case. Until recently, it was generally considered part of every top manager's job to manage earnings, that is, to report earnings other than as they actually are, and while somewhat less so now, this still tends to be true. When managers give their word to something other than what is actually so, in this case, their word as to the accuracy of the firm's reported financial statements, this leaves them less than whole and complete, and diminishes the opportunity for performance. That is, such fudging undermines the opportunity for maximizing firm value. For too long, we in finance have implicitly condoned or even collaborated in these activities. Specifically, we are referring to managing earnings, income smoothing, etc. These issues are not merely one of deciding on a strategy. They directly involve integrity and the generally unappreciated negative long-run value effects of such out-of-integrity behavior. Making organizational operating decisions other than those that maximize long-term firm value so as to manage reported earnings is a violation of word-4. If the markets had the evidence that we managers had when making such earnings management decisions, the markets would come to a different conclusion about the meaning of those managed earnings. That, incidentally, is the reason the various manipulations of accounting and real operating decisions are not fully disclosed to the markets. In everyday language, violating word-4 is lying. When we use terms other than lying to describe a violation of word-4, we inadvertently encourage the sacrifice of integrity. We have observed perfectly honest, upstanding people in their roles as board members condone manipulation of financial reports because it does not show up to them as lying. It occurs to them as just part of what it means to manage. Such language effectively disables even the normal social sanctions that would limit such behavior in boardrooms and among managers as they openly discuss how to manage earnings. As we've previously discussed, the cost of this out-of-integrity behavior will be attributed to something other than this out-of-integrity behavior, i.e., managerial lying about earnings. As we said above, language affects the way in which what is being dealt with occurs to people. And the way what is being dealt with occurs to people affects their behavior. When executives and firms give their word to something other than what is actually so, that is, manage earnings, it shifts the way in which the firm occurs to its executives. Their focus shifts away from maximizing value to how to win the short-term gains from manipulating analysts and the expectations of the market. Investment banks defrauding clients. Banks and investment banks misleading clients with misleading investment recommendations that clients have been led to believe are intended to serve the client is not whole and complete with regard to their word. Goldman Sachs, for example, was accused of misleading its clients in the abacus mortgage-backed securities that were intentionally structured to fail, for which Goldman paid a $550 million settlement to the SEC in 2010, at the time the largest ever in the history of the SEC. In addition, Goldman Sachs trader Fabrice Tura was found guilty on 6 counts of fraud for his role in the abacus debacle. Also consistent with the dramatic decline in organizational integrity at Goldman Sachs in recent years, Greg Smith resigned as executive director and head of Goldman's United States equity derivatives business in Europe, the Middle East and Africa on March 14, 2012, with his New York Times op-ed article entitled, "Why I Am Leaving Goldman Sachs." Quoting Smith, 2012, "After almost 12 years at Goldman Sachs, I believe I have worked here long enough to understand the trajectory of its culture, its people, and its identity. And I can honestly say that the environment now is as toxic and destructive as I have ever seen it. To put the problem in the simplest terms, the interests of the client continue to be sidelined in the way the firm operates and thinks about making money." Culture was always a vital part of Goldman Sachs's success. It revolved around teamwork, integrity, a spirit of humility, and always doing right by our clients. The culture was the secret sauce that made this place great and allowed us to earn our clients' trust for 143 years. It wasn't just about making money. This alone will not sustain a firm for so long. Today, if you make enough money for the firm and are not currently an axe murderer, you will be promoted into a position of influence. What are 3 quick ways to become a leader at Goldman? A. Execute on the firm's axes. which is Goldman speak for persuading your clients to invest in the stocks or other products that we are trying to get rid of because they are not seen as having a lot of potential profit. B. Hunt elephants. In English, get your clients, some of whom are sophisticated and some of whom aren't, to trade whatever will bring the biggest profit to Goldman. Call me old-fashioned, but I don't like selling my clients a product that is wrong for them. I attend derivative sales meetings where not one single minute is spent asking questions about how we can help clients. It's purely about how we can make the most possible money off of them. It makes me ill how callously people talk about ripping their clients off. Over the last 12 months, I have seen 5 different managing directors refer to their own clients as Muppets, sometimes over internal email. No humility. I mean, come on. Integrity. It is eroding. I don't know of any illegal behavior, but will people push the envelope and pitch lucrative and complicated products to clients even if they are not the simplest investments or the ones most directly aligned with the client's goals? Absolutely. Every day, in fact. It astounds me how little senior management gets a basic truth. If clients don't trust you, they will eventually stop doing business with you. It doesn't matter how smart you are. People who care only about making money will not sustain this firm or the trust of its clients for very much longer. Based on the evidence on the Goldman culture summarized by Smith, the conversation within Goldman Sachs about its relation to clients, or stated as a matter of integrity, the firm's word to itself about its relation to clients, is obviously inimical to the interests of its clients. What is clearly invisible to Goldman Sachs management is that such behavior, because it is out of integrity, is also contrary to Goldman's own interests. Goldman's out-of-integrity behavior is evidenced in the conflict between the firm's word to itself about its relation to clients and its word to its clients. And as Smith says about the resulting damage to the firm from such behavior, if clients don't trust you, they will eventually stop doing business with you. On its website, Goldman Sachs represents itself and gives its word to the world, including its clients, in the statement of its business principles and standards. Goldman Sachs Business Principles. 30. The first and last of Goldman's 13 business principles state, our clients' interests always come first. Our experience shows that if we serve our clients well, our own success will follow. Integrity and honesty are at the heart of our business. Given what Smith reveals about the conversation within Goldman Sachs about the firm's relation to clients, the firm's word to itself, Goldman Sachs' word to its clients is clearly not whole, and is incomplete and broken, the very definition of out of integrity. The obvious cost to Goldman Sachs and other firms of not seeing the impact of out-of-integrity behavior is the cost of lawsuits, penalties, and settlements. But the non-obvious costs of such behavior is the impact on clients' behavior, and the extent of the reduced reputation and morale of the firm, all of which are much less obvious and sometimes dismissed as just the cost of doing business. Such out-of-integrity behavior in the financial world is not limited to Goldman Sachs. Smith is dumbfounded at Goldman not seeing the self-inflicted damage from its out-of-integrity behavior, how little senior management gets a basic truth. If clients don't trust you, they will eventually stop doing business with you. Mastering the 11 factors that constitute the veil of invisibility creates actionable access to eliminating the damage done by out-of-integrity behavior, or at least unconceals the behaviors that are generating the damage. Interestingly, Smith's 2012 book, Why I Left Goldman Sachs, A Wall Street Story, and his resignation letter has been criticized by figures in the financial press and members of the financial community. For example, see Blankfein and Cohen, Stewart, Roos, Schatzker, and Rule. We conjecture that many in the Wall Street community considered the Smith book's accusations unimportant because they expected and did not find documentation of rampant, outright illegal behavior in the book. The book contains considerable discussion of out-of-integrity behavior and the damage it is likely to cause, although Smith does not use that specific integrity language. This failure of the financial community to recognize the lack of integrity at Goldman described by Smith, and the financial community's failure to see its importance, says something noteworthy about the culture of the Wall Street community and the press that covers it. Smith's book clearly indicates a serious lack of integrity in the culture at Goldman. And the book is consistent with the out-of-integrity actions that Goldman has taken in such deals as the Abacus 2007 Acon mortgage-backed securities issue, in which Goldman intentionally structured that issue to fail and misrepresented those securities to its purchasers. Goldman's clients lost over $1 billion within months of their purchase of Abacus, and Goldman paid a fine of $550 million to the SEC. Michael Lewis, 2013, had the following to say about the Smith-Goldman events. Either way, you had to admire Greg Smith's nerve. Still, his piece raised a couple of questions that I hoped his book might answer. The first is, why now? Goldman was helping the Greek government deceive the European Union about its indebtedness back in 2001. By 2004, the firm was busy manipulating the ratings agencies and the investing public to help expand the market for subprime mortgage bonds. By 2006, it was designing securities to fail the infamous Abacus program, so that its own traders could bet against them and make profits at the expense of their own customers by, in effect, pumping vast amounts of trust-reducing pollution into the financial system. For a very long time now, the firm has been famous for being more frightening than helpful to its customers. Smith first worked for Goldman as an intern in the summer of 2000, near the peak of an internet bubble that was inflated with the help of Goldman's analysts. Consistent with Smith's judgments regarding Goldman Sachs' out-of-integrity behavior, Bodnaruk, in their empirical study of the dark role of investment banks in the market for corporate control, find that out-of-integrity behavior goes far beyond Goldman Sachs. As they conclude, we argue that advisors are privy to information about the deal that they directly exploit in the market by investing in the target. We show that the bank's advisors to the bidders tend to have positions in the target before the deal. The existence of a direct stake of the advisor to the bidder increases the probability of the bid and the target premium. Advisory banks profit from such a position. A trading strategy that conditions on the stake of the advisors delivers a net of risk performance of 4.08% per month. This cannot be replicated with available information. We also show that advisors not only take positions in the deals they advise on, but also directly affect the outcome of the deal and its probability of success. This has negative implications for the viability of the new entity. Money managers defrauding clients. Money managers have allowed certain favored investors to engage in market timing operations, for example, after-hours trading at stale prices, that allowed these favored investors to sell or purchase shares at prices above or below the actual value of those shares. Such practices allow those favored investors to transfer wealth from non-favored fund investors to themselves. Well-known fund organizations that were accused of allowing such behavior and fired employees as a result of the investigations and slashed or paid penalties to settle the charges include Putnam Investments, Strong Capital Management, Morgan Stanley, Janus Capital Group, Bear Stearns, Bank of America, and Invesco. In some cases, the managers of the funds, for example, Strong Capital Management, engaged in such trading themselves in personal violation of their fiduciary duties to fund investors. Corporate governance, putting integrity into the organization as a system and as a human entity. Put integrity into boards of directors. Boards of directors are ultimately accountable for the performance of the organization as a whole. This accountability for performance includes the performance of 1. The organization as a system, and 2. The organization as a human entity. The logic chain to the ultimate outcome is as follows. The organization as a system is constituted as follows: the design of the system, the implementation of the design, and the use of the system. The organization as a human entity is constituted as follows. The word of the entity itself includes those individuals who are taken to speak for the entity, and the word of the individuals who make up the entity. An organization is out of integrity when the organization as a system or as a human entity, or both, is less than whole, complete, unbroken, unimpaired, sound, in perfect condition. When an organization as a system or as a human entity is less than whole, complete, unbroken, unimpaired, sound, in perfect condition, the workability of the organization as a system or as a human entity, or both, is diminished. When the workability of an organization as a system or as a human entity is diminished, the organization's opportunity for performance is diminished. Given that boards of directors are ultimately accountable for organizational performance, and given that out-of-integrity behavior of the organization as a system or as a human entity diminishes the organization's opportunity for performance, this necessarily leaves boards of directors accountable for the integrity of the organization both as a system and as a human entity. An organization's executive compensation plan is an example of the organization as a system. The board of directors is ultimately accountable for the workability and performance of that system. The board of directors is therefore necessarily accountable for the integrity of 1. The design of the organization's executive compensation plan, 2. The implementation of that design, and 3. The use of the implemented plan. An example of an out-of-integrity design of an organization's executive compensation plan is the budget or target-based executive compensation plan that most companies use. In addition, what gets said and what is unsaid in an organization's boardroom is an example of the organization as a human entity. Integrity for a human entity is a matter of that entity's word, nothing more and nothing less. When what is said in the organization's boardroom is less than whole, complete, unbroken, unimpaired, sound, in perfect condition, such out-of-integrity behavior diminishes the workability of the board. When workability is diminished, the opportunity for performance is diminished. An example of out-of-integrity behavior in boards of directors, or for that matter executive teams, is the existence of undiscussables in the boardroom, that is, what the firm may be getting by with, but is so questionable that if it is put up on the table it probably has to cease. Anything that is undiscussable leaves the board as a human entity less than whole, complete, unbroken, unimpaired, sound, in perfect condition. As a result, workability and value are sacrificed. No human entity in which there are issues that are undiscussable can be whole and complete. If you doubt that there are undiscussables in the background of most board meetings, and indeed most executive committees, just try raising the issue of one or more undiscussables. You will quickly discover that it is undiscussable that there are undiscussables. These undiscussables are always trouble waiting to happen, and there is no way to head off the trouble as long as the issues are undiscussable. Indicators of the lack of integrity in the governance and management of financial firms and their advisors. These indicators of a lack of integrity include those professional firms who serve both the supply and demand side of financial services. Specifically, this includes law firms, banks, investment banks, brokerage firms, accounting firms, and consulting firms, especially compensation consultants, as well as other financial service firms including mutual funds, hedge funds, and private equity funds. For managers and directors of financial firms and their advisors, Forthcoming, 2006, in his speech, Integrity in Finance, given to the Swiss Banking Institute, offers some all-too-common explicit indicators of the existence of out-of-integrity behavior in their organizations. Everyone else is doing it. We've always done it. This is the way this business works. If we don't do it, somebody else will. Nobody's hurt by it. It doesn't matter how it gets done, as long as it gets done. It works, so let's not ask too many questions. No one's going to notice, and besides, we will fix it before they do. It's legal, but it's too expensive. It has to be done to save the organization, and by the way, a lot of jobs. Because the widespread lack of integrity in organizations reduces long-term value, it raises the question, how can it persist if it destroys long-run value? We address this issue in the next section. The general lack of integrity in relations with capital markets. There are many reasons for the lack of integrity in the relations between firms and capital markets. But a major contributor to this situation is that markets reward and punish managers in ways very similar to those budget-based compensation systems that pay people to lie, that is, systems that pay people to underpromise and overdeliver. Indeed, many readers have undoubtedly heard managers and executives explicitly announce underpromise and overdeliver as both a personal and management philosophy. It is certainly out of integrity. Stripping away the politeness, a management or behavioral philosophy of under-promise and over-deliver actually means in many situations, lie and lie. I lie to you about what I can deliver, a low profit, and I lie to you about what is actually delivered, a high profit, another example of violations of word-minus 4. Put this way, it is obvious what happens to integrity, trust, and reliability in cultures where such behavior becomes generally accepted. We now turn to an analysis of one of the market forces that encourage managers to engage in gaming behavior such as underpromise and overdeliver. Figure below from Skinner and Sloan, 2002, illustrates vividly how markets reward and punish managers for meeting or beating the analyst's consensus quarterly earnings forecast over the period 1984–1996. The graph plots quarterly abnormal returns for growth firms and value firms as a function of earnings surprise at the end of the quarter. Forecast error is measured as the earnings surprise relative to the quarter-end stock price. Growth firms are those with high market value to book value ratios, and value firms are those with low market value to book value ratios. A 1% positive earnings surprise results on average in a 10% abnormal stock return for growth firms, and approximately a minus 15% abnormal stock return for missing the quarterly earnings forecast by 1%. For value firms, non-growth firms, the comparable abnormal returns are 6% and -3% respectively. Managers of a firm facing these sorts of rewards and punishments from the capital markets have incentives to take long-run, value-destroying actions to satisfy the market's short-run expectations. Interestingly, the relation between a firm's top management team and the capital markets has resulted in an equilibrium that replicates many counterproductive aspects of corporate internal budget or target-based bonus systems. Thus, the capital markets provide further short-run incentives for managers to take out-of-integrity actions to meet market expectations. For corporate executives holding large quantities of restricted stock and stock options, Figure 1 portrays the pay-performance relation that defines how meeting, beating, or missing analyst forecasts affects the value of their equity-based holdings. Figure above has the same general shape as a smoothed version of the typical nonlinear managerial bonus pay-performance relation depicted in figure below and discussed in Murphy and Jensen, 2011, and produces the same counterproductive incentives. Therefore, we discuss in some detail the incentives managers face under the bonus plans represented. Figure illustrates the common management compensation practice in which a manager's salary plus bonus is constant until a minimum threshold performance is reached, commonly 80% of the target or budgeted performance level. At 80% of the target performance, the manager receives a bonus for making the threshold performance target. This bonus is often substantial, and as performance increases above this hurdle, the bonus increases until it is capped at some maximum. 120% of the target performance is common. Performance above this upper limit generates no additional bonus. Consider managers' incentives when they are struggling to reach the minimum hurdle. In this situation, as long as they believe they can make the threshold performance, managers will engage in actions to increase their performance, and this can be done by legitimate or illegitimate means. When the measure is profits or some variation of profits, managers have incentives to increase this year's profits at the expense of future year's profits by moving expenses from this year to the future, by delaying purchases, for example, or by moving revenues from future years into this year by booking orders early, by announcing future price increases, by giving special discounts this year, or by guaranteeing to repurchase goods in the future, and so on. When these actions simply move profits from one year to another, the adverse impact on firm value is probably small. But it can pay managers today to engage in actions that reduce the total value of firm cash flows by moving profits to the current period, even when future profits are dramatically reduced. When managers conclude that they cannot make the minimum threshold hurdle, their incentives shift dramatically, because if the manager is going to miss the bonus this year, there is no further reduction in compensation from performance that is even farther away from the lower threshold amount, subject always to the condition that the manager is not fired. In this situation, managers have incentives to do the opposite of what we just described. That is, they now have incentives to move profits, if that is the performance measure, from the present to the future. They can do this by moving expenses from the future to the present period, by prepaying expenses, taking write-offs for restructuring, etc., and by moving revenues from the present to the future. This is the big bath theory, and the phenomenon is regularly observed when firms faced with missing analyst expectations take a big bath to improve their ability to meet analyst expectations in the future. Finally, managers who are within reach of the bonus cap have incentives to not exceed the cap because they get no rewards beyond that point, and these perverse incentives are even stronger if this year's performance is used in setting next year's targets. In this situation, managers have incentives to move expenses from the future to the present and revenues from the present to the future to avoid exceeding the bonus cap this year and to increase bonuses in future years. And again, managers have incentives to do this even if it imposes real costs on the company. Suffice it to say that all of the behavior described above is a violation of Word-4 and is therefore out of integrity and leads to unworkability and value destruction. And note that all this destructive behavior by the human beings in the organization is motivated by the fact that this common bonus plan is out of integrity in its design as a system. Eliminating this counterproductive behavior must start by eliminating the lack of integrity in the design of the compensation system. Asking the human beings operating in this badly designed system to change their behavior will fail unless and until the compensation system itself is redesigned to put it into integrity. Popular recommendations to solve these incentive problems in the banking and financial industry as a whole tend to focus on eliminating bonuses, often motivated by the perception that the way the bonus plan works leaves top people paid too much, rather than that the bonus plan rewards people in the wrong way and for the wrong things. This approach addresses nothing about the design of these plans and ignores the potentially huge damaging effects associated with a mass exodus of highly qualified people from the banking and financial industry. Further evidence on management manipulation of earnings. Evidence from a survey of 401 CFOs reveals a fundamental lack of integrity. Graham, Harvey, and Rajgopal's survey of 401 CFOs find that 78% of surveyed executives are willing to knowingly sacrifice value to smooth earnings. While it seems that recent scandals have made CFOs less willing to use accounting manipulations to manage earnings, this survey indicates that to meet short-run earnings targets, CFOs are willing to change the real operating decisions of the firm and thereby destroy long-run value. When smoothing earnings, it is true that a CFO could maintain his/her integrity, their word, and their firm's word being whole, complete, etc. by making something like the following public announcement each time they make such value-destroying decisions. Given how I am paid, I am rejecting or delaying a firm value-increasing project in order to meet analysts' consensus earnings forecast so as to increase my own pay. We would guess that relatively few CEOs and CFOs would actually make such announcements to their board of directors, analysts, and the public. Aggregate evidence on the manipulation of corporate earnings. Figure 3 displays the aggregate evidence from the DeGorge, Patel, and Zeckhauser 1999 study of the errors, measured in cents per share of corporate earnings, between actual earnings and analysts' consensus earnings forecast for over 100. Quarterly observations on over 5,000 firms in the 1974–1,996 period. The distribution is not symmetrically distributed around zero. In fact, there are far too many observations at exactly zero, as indicated by the center tall bar. It is interesting that lost from view in Figure 1 is that the stock price response from hitting exactly zero, i.e., exactly hitting expectations, is significantly negative and lower than the response for missing expectations by, say, 1%. The explanation seems to be that the zeros are most likely the result of CEOs manipulating earnings upward to get exactly to zero, and the market understands that and sees it as negative information. Indeed, the black areas below the x-axis denote the deficiency in frequency of observations in the intervals of the distribution that would be expected if the true underlying distribution were symmetrical around zero. There are far too few observations in the intervals between -4 cents per share and -1 cent per share, where firms have missed analysts' consensus earnings forecast by a small amount, and far too few observations in the intervals greater than +4 cents per share, where firms significantly exceeded the analyst forecasts. These results are consistent with the hypothesis that management is manipulating earnings to show far too many instances of quarterly earnings reports that exactly meet or just beat analysts' expected earnings, and far too few instances of quarterly earnings reports in the interval of -1 and -4 cents per share below analysts' expected earnings. This is accomplished by reporting lower than actual earnings when earnings would be substantially above analysts' expectations, and storing the hidden earnings so that the firm could report just meeting or beating analysts' expectations when the firm's earnings actually would have come in below those expectations. And the manipulation of earnings extends to the reporting of hedge fund returns. It appears that hedge funds regularly report smooth month-to-month returns. This apparently results from the fact that being able to say, "We have only had X months of negative returns," X being a very small number, has a big impact on attracting investors to the fund. This means that reporting a return of +1% rather than 1% in any month leads to a large advantage in recruiting and retaining investors. And consistent with this, the evidence indicates that the distribution of returns for hard-to-value hedge funds shows way too many monthly returns just above zero and way too few just below zero. This is consistent with the hypothesis that hedge funds systematically underprice the value of the fund during the year so that they can smooth out the returns from month to month and avoid reporting negative returns in any month. Consistent with this hypothesis that hedge funds manipulate the month-to-month value of their funds to serve their own interest, the contractual features of hedge funds provide them strong incentives to inflate returns in December of each year. And the evidence indicates they do so. Hedge funds earn incentive fees if they beat their contractual benchmarks, and better performance increases investor contributions to the fund. Agarwal, Daniel, and Naik, 2010, provide strong evidence documenting this phenomenon. They find that the average December return is more than twice as high as the average returns for the entire 11 months January through November. In the author's words, "In this paper, we provide strong evidence of hedge funds inflating their returns in an opportunistic fashion to increase their compensation. Specifically, we find funds that stand to gain the most from good performance, the funds that stand to lose the most from poor performance, and the funds that have greater opportunities to engage in return inflation exhibit the greatest spike in December returns." We also provide evidence on two potential mechanisms employed by hedge funds to manage returns. The first method involves funds underreporting their returns in the early part of the year in order to create reserves for possible poor performance later in the year, saving for the rainy day. In case some of these reserves are left unutilized, they get added to the December returns, resulting in the spike. The second mechanism involves funds borrowing from their January returns of the subsequent year to improve their December returns. This can be achieved by funds pushing up the security prices at December end by last-minute buying, which is followed by price reversals in January. And this violation of word-4, the other would find the evidence for my assertion also valid for themselves, extends to the reporting of analyst recommendations. Lundqvist, Malloy, and Marston, 2007, in their paper Rewriting History, study the major historical database of financial analyst stock recommendations and find substantial evidence that the historical record, as reported in the widely used database produced by Thomson Financial, does not represent the recommendations that were actually made by many of the analysts. They conclude, comparing two snapshots of the entire historical database of research analyst stock recommendations, taken in 2002 and 2004, but each covering the same time period 1993–2002. We identify tens of thousands of changes which collectively call into question the principle of replicability of empirical research. The changes are of four types. 1. The non-random removal of 19,904 analyst names from historic recommendations, anonymizations. 2. The addition of 19,204 new records that were not previously part of the database. 3. The removal of 4923 records that had been in the data, and 4. Alterations to 10,698 historical recommendation levels. In total, we document 54,729 ex-post changes to a database originally containing 280,463 observations. As of February 2007, Thomson Financial's position is that changes to recommendation history have occurred as part of necessary processes and maintenance. Previously, Thomson had indicated that the anonymizations were the result of 3 software glitches. The first produced incorrect start and end dates for some analysts' employment histories. The second caused selective ticker histories for certain analysts to be anonymized, in connection with attempts to consolidate duplicate analyst identifiers. The third, which can still occur, results in recommendations being attributed to an analyst who has departed. Subsequent corrections involve anonymizing such recommendations. Lundqvist, Malloy, and Marston, 2007 continue. At the recommendation level, the collective effect of the changes is to make the overall distribution of historic recommendations issued for U.S. companies between October 1993 and July 2002 appear more conservative in 2004 than it did in 2002, with considerably fewer strong buys and more holds, sells, and strong sells. Broker-level data, which can be used to predict the profitability of stock recommendations, change even more dramatically. One reason why these findings are important is that the apparently optimistic bias in the historical distribution of recommendations was a frequently cited impetus to the regulatory proceedings that culminated in the global research analyst settlement of 2003 between New York Attorney General Eliot Spitzer, the SEC, NASD, NYSE, North American Securities Administrators Association, state regulators, and 12 brokerage firms. Similarly, the changes impact the implementation of popular trading strategies based on analyst consensus recommendations. A simple trading strategy that buys stocks in the top consensus change quintile and shorts stocks in the lowest quintile each month performs 15.9% to 42.4% better on the 2004 tape than on the 2002 tape, suggesting that the changes to the database have resulted in the appearance of more profitable analyst research. Track records of individual analysts are also affected. Among the group of analysts with anonymized recommendations, we find that abnormal returns following subsequently anonymized upgrades to buy are significantly lower than our abnormal returns following upgrades by the same analysts that remained untouched. The return differential is large, ranging from 3.6% to 4% PA over the 1993–2002 period. It is even larger in the most recent post-bubble period, as high as 7.4% PA, and for the subsample of bolder recommendations, 5.2% and 9.1% PA in the full sample and post-bubble periods, respectively. Analysts whose track records are affected are associated with more favorable career outcomes over the 2000 and 3–2005 period than their track records and abilities would otherwise warrant. Following the career path modeling in Hong, Kubik, and Solomon, 2000 closely, we find that analysts associated with anonymizations experience a more than 60% increase in the likelihood of subsequently moving from a low-status to a high-status brokerage firm. This effect is much larger than any other in our career outcome models. The magnitude of the effect of additions on career outcomes is also large, boosting the likelihood by more than 40%. Similarly, analysts are more likely to be rated the top stock picker in their sectors by the Wall Street Journal, which relies on Thomson Financial data, if some of their recommendations have been dropped or added. Collectively, our findings raise serious doubts about the replicability of past, current, and future studies using the historical recommendations database. Collusion between analysts and FIRMS. Hutton's 2004 study of firms' audits of analysts' spreadsheet earnings models result in the following. Of 421 firms responding to the NIRI 2001 survey, 85.5% reviewed analysts' models. She labeled these guidance firms. These analysts showed more accurate forecasts in the sense of lower mean squared errors. But these analysts' forecasts were systematically downward biased, therefore yielding systematic positive earnings surprises. Analysts of the no-guidance firms walked down their estimated earnings in response to negative earnings surprises, 47% with 3 to 4 quarters of negative earnings news during the year. However, analysts of the guidance firms walked down their earnings estimates, even though 49% of the firms have 3 to 4 quarters of positive earnings news. This walkdown gives management a year-end boost and indicates a positive beginning-of-year bias. The walkdown practice is consistent with the hypothesis that these analysts ended up issuing forecasts that resulted in systematically positive earnings surprises, so as to incur favor with the management team. If this hypothesis is correct, then in return for such positive earnings surprises, analysts receive favors from management that enable them to make more accurate, although more biased, forecasts. Matsumoto and Bartov, Givali and Hain document that the managing earnings game seems to have arisen in the mid-1990s. They find that over the period from 1983–93 to the period 1994–97, the proportion of negative end-of-quarter earnings surprises fall from 48% to 31%. Positive end-of-quarter earnings surprises increase from 40% to 50%. Zero earnings surprises increase from 12% to 19%. The upward bias in the one-quarter ahead forecast increased. A 3% premium return arose for meeting or beating analyst forecasts at the end of quarter. A small penalty for negative revisions of forecast during quarter arose. The peculiar equilibrium between analysts and FIRMS. Analysts' long-run, 12-month ahead forecasts are systematically biased high. These forecasts are then walked down so that at the realization date they are systematically low. In this situation, investors appear to get taken fooled in both cases, as indicated by the positively biased forecasts at the beginning of the period, and the walk down to the negatively biased forecasts at the end of the period. On the face of it, this seems highly inconsistent. One potential hypothesis to explain this inconsistency is that analysts appear to be colluding with managers to allow those managers to have the benefits of excessively high long-term forecasts while also allowing the managers to meet or beat the short-run forecasts at the end of the quarter. But it seems impossible for effective collusion to take place amongst so many players. Figure is based on aggregate 1984–2001 data from Richardson, Teo, and Wysocki, 2004, provided by the authors, and shows the median difference of the forecast earnings per share and actual earnings per share, scaled by the prior year share price. The sample consists of all individual analyst forecasts for firms with data on both database and Compustat, and shows that the median consensus analyst forecast is initially positively biased, but that analysts walk down these forecasts each month. By the month of the actual earnings announcement, the median consensus forecast is negatively and statistically significantly biased. That is, the median company reports earnings slightly exceeding the year-end analyst forecast. The walk-down results from management pressure and analyst self-selection. One explanation of this peculiar phenomenon is as follows. Suppose management imposes costs on analysts who are pessimistic or not sufficiently optimistic about the future results of the firm. Suppose such analysts opt out of reporting their bad news on companies without announcing why they opt out, or perhaps they drop their coverage of the firm completely. McNichols and O'Brien, 1997, provide an intuitively appealing explanation of this hypothesis and present evidence that the observed phenomenon is not due to analysts making systematically biased estimates but rather due to analysts that self-select out of reporting bad news on companies. If there is a range of analyst opinions about a company in any given month, and the analysts with the most negative opinions or information systematically choose not to offer a report, the resulting consensus opinion, consisting only of analysts who actually report, will be upward biased, even if each reporting analyst is unbiased in his or her opinion. Analysts with the negative opinions may well opt out of, or delay issuing a recommendation until late in the period, and may drop their coverage of a stock entirely to avoid the negative repercussions from management and others who are long the stock of the company. It is well known, for example, that analysts seldom issue sell recommendations and frequently delay issuance of reports downgrading a firm. The fact that analysts seldom issue sell recommendations and often delay downgrades of a firm is consistent with this hypothesis that analysts with negative opinions delay issuing their forecasts, or do not issue them at all, to avoid offending management. The resulting consensus forecast is then biased upward. Consistent with this hypothesis, Skinner and Sloan, 2002, conclude. Analysts' long-run EPS forecasts are systematically over-optimistic for growth firms, and this is systematically related to the inferior stock price performance of growth firms. See also DeChow, Hutton and Sloan, 1999, abstract, who conclude. Sell-side analysts' long-term growth forecasts are systematically overly optimistic around equity offerings, and that analysts employed by the lead managers of the offerings make the most optimistic growth forecasts. Additionally, we find a positive relation between the fees paid to the affiliated analysts' employers and the level of the affiliated analysts' growth forecasts. We also document that the post-offering underperformance is most pronounced for firms with the highest growth forecasts made by affiliated analysts. These facts are consistent with a system that is out of integrity and thereby destroys value. In this case, the managers that punish analysts who publish accurate but negative, or less positive, forecasts or recommendations are out of integrity because the actions of such managers are not consistent with the expectation, unexpressed request, of holders of the firm's securities that management provide the market with accurate and unbiased financial reports on the firm's performance. More evidence that both managers and analysts manipulate earnings. Marquardt and Weidman, 2002, find that managers use accruals to manage earnings either up or down in situations to fit their own interests. At times of equity issues, firms use accruals to increase earnings and therefore stock price. On the other hand, in management buyout situations, firms use accruals to decrease earnings and therefore stock price. The frequency of small quarterly profits is unusually large, and the frequency of small losses is unusually small. And so too for small increases and decreases in profits. Managers change real operating decisions, such as reducing research and development or advertising expenditures to meet benchmarks. Managers manipulate earnings upward around new equity offerings. Systematically overly optimistic analyst long-term growth forecasts around equity offerings are associated with the largest post-IPO underperformance. Myers and Skinner, 2005, find huge numbers of firms with consecutive strings of quarterly EPS non-decreases relative to the expected number. They find evidence consistent with the hypothesis that managers of sample firms take actions to increase reported EPS when EPS would otherwise decline, and Roman 2, decrease reported EPS when EPS would otherwise increase by more than necessary to record an increase. Their evidence indicates this is done by strategically reporting special items, strategically timing stock repurchases, and exercising discretion over accounting for taxes to smooth changes in EPS. They conclude, of all Compustat firms with at least 40 quarters of available data, 811 firms report earnings strings of at least 20 quarters. The corresponding expected number of firms varies between 28 and 71, again depending on the assumed time series model generating quarterly earnings. In conclusion, We argue that the financial economics paradigm is incomplete. The evidence for any paradigm being incomplete is the presence of a significant continuing breakdown in the discipline, along with the discipline's continuing ineffectiveness in dealing with that breakdown. In the world of finance, the combination of 1, the extent of out-of-integrity behavior and its consequent impact on value, coupled with 2, the financial economics discipline having provided little or nothing that has been effective in stemming this out-of-integrity behavior, is evidence for our argument that the financial economics paradigm is incomplete. The out-of-integrity behavior we termed the scandals and the various examples of out-of-integrity behavior discussed, mostly unrecognized as out-of-integrity behavior, are important examples of what contributes to the general atmosphere of low integrity in the world of finance, albeit not identified as such and certainly not spoken of. Out-of-integrity behavior has become virtually institutionalized. The environment of low integrity is so pervasive it seems to be nothing more than business as usual, or just a part of the nature of finance. Forthcoming's 2006 first 3 indicators of the lack of integrity: everyone else is doing it, we've always done it, and this is the way this business works, illustrate this environment. When we speak of integrity in the case of a system or object, we mean nothing more than but nothing less than that the design, the implementation of the design, and the use of the system or object are whole, complete, unbroken, sound, in perfect condition with respect to its intended purpose. When we speak of integrity for a person or other human entity, we mean nothing more than but nothing less than that the word as defined earlier of the person or other human entity is whole, complete, unbroken, sound, in perfect condition. We have shown that integrity dealt with in this way is an important factor of production. However, integrity as it is currently understood has been undistinguished as a factor of production, with the result that its impact on workability, and therefore productivity and value, by its presence or absence, has been wrongfully assigned to other causes. Integrity, as we define it, matters, not because it is virtuous, but because it creates workability. And workability increases the opportunity for performance, and maximum workability is necessary for realizing maximum value. Note that describing the effects of integrity is not normative. In addition, we make no admonition to act with integrity. It doesn't work to tell people what they should do. People act in what they perceive to be in their self-interest, in the way it shows up for them in the circumstances they are dealing with or are confronted by. We don't tell people what to do, rather we give a picture of reality. In this case, a picture of the reality of integrity revealed as a positive phenomenon that naturally alters their correlated behavior. As the law of integrity states, as the integrity, the state of being whole and complete, etc., of an object, system, person, or other human entity or practice declines, workability declines. And as workability declines, the opportunity for performance declines. Note, however, that when the behavior is not recognized as out of integrity, the decline in the opportunity for performance will be explained in some other way. The model of integrity introduced in this paper makes clear just how widespread out-of-integrity behavior actually is, and the enormity of the cost of out-of-integrity behavior. The model also makes clear that given the way integrity is currently understood, our out-of-integrity behavior does not occur for us as such. And as a result, we ascribe the cause of the damage of out-of-integrity behavior to something other than our out-of-integrity behavior. But the recognition of the foregoing is only a beginning for persons, groups, and organizations to have access to acting with integrity. From within our new model of integrity, when it is fully understood, integrity occurs for people, is understood by people, shows up for people such that out-of-integrity behavior actually shows up for people as out-of-integrity behavior, but most importantly, the damaging consequences of that behavior, whether immediate or long-term, show up in present time right along with the out-of-integrity behavior, and the damaging consequences show up as being caused by the out-of-integrity behavior. This shift in the showing up profoundly alters the way out-of-integrity behavior occurs or shows up for people. As we have said, people with normal brains act in what appears to them to be in their self-interest, but in their self-interest given the way in which what they are dealing with occurs or shows up for them. Our purpose here has been to show that including integrity as a purely positive phenomenon, and as such an important factor of production in the paradigm of financial economics, would allow financial economics scholars to develop the tools to effectively deal with the crises and anomalies of the value-destroying out-of-integrity behavior in the world of finance, and ultimately to transform the culture of finance to be one of integrity.